My name is Ben from Ben Invests, and I want to start this video with something that nobody in personal finance ever says out loud. Being broke is not just painful. It is expensive, measurably, mathematically, provably expensive in ways that compound quietly against you every single month, year after year, while the system that charges you for it never once sends you a bill. If you've ever felt like your money disappears faster than it should, you're not imagining it. Hichi, subscribe every week. We run the real math they never taught you. And drop a like if this helps put language to something you've felt your whole life but could never quite name. Here is the stat that started this entire video for me. The bottom 40% of Americans pay MORE per unit for the same products, the same loans, the same groceries as the top 20%. Not because they spend more recklessly, because the system charges them more structurally. Same city, same needs. Radically different price tags. And if you think being financially struggling is just about not earning enough, you are missing the most dangerous half of the equation. Because there is a second tax, a hidden one. Nobody handed you the code. Let me show you exactly how it works. There is a concept in economics called the poverty premium. And once you understand it, you will never look at a bank fee, a loan rate, or a grocery store receipt the same way again. The core idea is this. The less money you have, the more everything costs you per unit. Not in total. Per unit. The math is cruel, and it is precise. Economists have been documenting this for decades. The framework is simple. Low income correlates with higher unit prices across nearly every category of life. Housing, credit, food, banking, insurance, transportation, every single one. Two people, same city, completely different cost structures. Not because of their choices, because of their access. And here is where it gets structural. The poverty premium exists for 5 specific and interconnected reasons, none of which are the person's fault, and all of which the financial industry has zero incentive to explain. First, risk pricing. Lenders, landlords, and insurers set their prices based on statistical default and loss rates. If the pool of borrowers in a certain income bracket defaults more often, regardless of why the price goes up for everyone in that pool, you are not being priced as an individual. You are being priced as a category. Second, bulk excess. If you cannot afford to buy in bulk, you pay more per unit. Always. The person buying a 24-pack pays less per roll than the person buying singles. This is not a secret. It is a structural advantage priced into every retail shelf in the country. Third, geographic concentration. Low-income areas have fewer competing businesses. Fewer competitors means higher prices by default. This is Econ 101. Less competition. Higher margins! Paid by whoever lives there. Fourth, credit as a gatekeeper. Your credit score is not just a number. It is a key, and it unlocks or locks cheaper versions of almost everything. The mortgage rate, the car loan, the apartment deposit. The insurance premium, the credit score, determines what tier of price you are allowed to pay for your own life. Fifth, time poverty. Working 2 jobs to cover rent does not leave you time to comparison shop, to read the fine print, to find the credit union with no fees, to call 3 different insurance companies. Time is a financial resource, and low-income households are the most time-poor households in the country. Now, why does nobody talk about this? Because financial education, even the good kind, focuses almost entirely on behavior. Spend less, save more. Stop buying things you don't need. And yes, behavior matters. But behavior cannot explain a 391% APR on a payday loan. Behavior cannot explain why to people with the same gross income, same work ethic, same job, pay nearly $10,000, different amounts in interest on the exact same car. The personal responsibility narrative, which is useful, up to a point becomes a cover story when it is used to obscure structural pricing math. And the banks, the lenders, the retailers, they have no incentive to hand you a document explaining that your zip code costs you $2,000 a year. None. So nobody does. Let's start doing the math they never showed you. Let me show you what this looks like in a real life. There are 2 people we're going to follow through this entire video. Marcus and Daniel. Same age, same city, similar gross income, both pulling in somewhere around $35,000 to $40,000 a year when we first meet them. Neither one is irresponsible. Neither one is stupid, but they are not starting from the same place. And by the end of this video, you are going to see exactly how wide that gap becomes and exactly why. Marcus does not have a bank account. This is not unusual. 5.9 million households in the United States are unbanked, according to FDIC data. And the reasons are rational. Past overdrafts that got him flagged. Minimum balance requirements he couldn't maintain. Fees he couldn't absorb. So he does what millions of people do. He cashes his checks. Here is the math on that decision. Check cashing services typically charge between 1% and 5% per check on a $35,000 annual income paid bi-weekly. Marcus is paying somewhere between $700 and $1,750 per year just to access his own money, just to hold cash that he already earned. That's it. The first number. Write it down. $700 to $1,750. Gone before he spends a single dollar on rent, food, or bills. And then add money, order fees for paying bills he can't pay online, wire transfer fees for sending money to family, prepaid card reload fees for every transaction that requires a card. These are not large amounts individually, but they stack. They stack every single week. And they never stop. Daniel, meanwhile, has a checking account at a credit union his mother helped him open when he was 19. He pays 0 monthly fees. His direct deposit clears at midnight. He earns a small amount of interest on his balance. He has never thought about the cost of accessing his own money, because for him, there isn't one. Same income. Completely different infrastructure. Different price. Now, let's talk about overdraft fees, because this is where the banking system gets particularly precise in who it charges. The average overdraft fee in the United States is between $29 and $35 per transaction. Banks collected $7.7 billion in overdraft revenue in 2022, and the data is consistent on one thing. The overwhelming majority of that money comes from low-balance account holders. People who are already one paycheck from zero. Here's the math that I want you to sit with for a moment. A $3 cup of coffee that triggers a $35 overdraft fee carries an effective cost of $1.38. The fee alone represents a 1,167% markup on the original purchase, and that fee can trigger a cascade the next transaction already queued. Now, also overdrafts. And another fee appears. And another overdraft protection. The product banks sell to solve this is itself a fee-generating mechanism. You pay for the protection. And the protection profits from the exact financial stress it claims to cushion. Wealthy customers never encounter this. Not because they are more disciplined, because they have buffers. The buffer is the product. The buffer is what you are actually buying when you have savings. And the people least able to buy the buffer pay the most for not having it. And then there are the minimum balance requirements. Most traditional bank accounts require you to maintain between $1,500 and $2,500 to avoid a monthly maintenance fee. The people least able to maintain those balances pay those fees every single month. Estimated annual fee burden for low-balance customers, $200 to $500 per year. Let's be very clear about what just happened here. We have documented a system in which the act of being a low-income customer at a traditional bank generates, conservatively, $900 to $2,000 in annual costs just for the privilege of holding and accessing money. Not spending it irresponsibly. Holding it, accessing it. The cost of existing inside the financial system with low reserves. Credit unions and online banks offer partial relief, no monthly fees, no minimum balance requirements, no overdraft cascade mechanics in many cases. But accessing them requires knowing they exist. And knowing they exist requires someone to tell you, nobody told Marcus. So what happens when Marcus needs money fast and banks won't give it to him? He walks into a payday lender. And this is where the math becomes extraordinary. Here is how payday loans work. You borrow a small amount, $300, $500 against your next paycheck. You pay a flat fee. The fee sounds manageable. $15 per $100 borrowed. You take $500. You owe $575 in 2 weeks. That sounds like $75. That sounds survivable. Here's what that actually is. $15 per $100 on a 14-day loan translates to an annual percentage rate of 391%. Not a typo. Not a rounding error. 391%. That is the legally permitted, openly operating rate charged on short-term loans to the people who can least afford the cost of borrowing. And then there is the rollover. 80% of payday loans, 80 are rolled over or renewed within 14 days. Because the person who needed $500 2 weeks ago still needs it. The $575 payment would have left them short again. So they roll it over. Pay another fee. The loan continues. Let me show you Marcus's math. Marcus takes a $500 payday loan. He rolls it over 6 times, which is slightly below average for payday loan users. By the time he pays off the original $500, he has paid $1,040. He needed $500. He repaid $1,040. The difference, $540 is the pure cost of being cash constrained in a country where the legal lending system charges 391% to the people who have no other option. The payday lending industry collects approximately $9 billion in fees per year from the lowest income Americans. And the geography of payday lenders is not accidental. Their density maps overlay almost perfectly with poverty maps. This is not targeting in the conspiratorial sense. It is market logic. They go where the demand is created by the absence of alternatives. That's a 391% tax on being broke. Now let's talk about credit score apartheid. That's a strong phrase. But I want you to look at the math and tell me a more accurate one. Same car, same dealership, same $25,000 sticker price, same 60-month loan term. Marcus has a 580 credit score. He qualifies for 80% APR. Over 5 years, he pays $12,894 in interest. Daniel has a 760 credit score. He qualifies for 5% APR. Over 5 years, he pays $3,307 in interest. The difference is $9,587 for the exact same car, driven the same miles, insured at the same price. The only variable is the 3-digit number assigned to their credit history. And here is the paradox that makes it structural rather than solvable by individual effort. You need credit to build credit. A credit history is required to access good credit rates. But building a credit history requires opening credit, which requires someone to give you credit in the first place. The bootstrap does not reach the ground. There are entry points, secured credit cards where you deposit $200 and it becomes your credit limit. Credit builder loans from credit unions, becoming an authorized user on a family member's account. These work. We will come back to them in part 8, but they require knowing about them. And they require someone not to have already told you that credit is too complicated to bother with. One mispayment, one can cascade across your entire financial cost structure for the next 7 years. Higher loan rates, higher insurance premiums, larger apartment deposits. Every system that uses a credit score to set a price adjusts upward simultaneously from a single missed payment. The impact is not contained. It spreads. Now, rent to a $600 washing machine. You need it. You do not have $600. You also do not have the credit score to finance it conventionally. The rent-to-own store offers you a solution, $19.99 a week. No credit check, no down payment. Walk out with the washer today. Here is the full math. $19.99 per week times 78 weeks. A standard rent-to-own contract equals $1,559. For a $600 appliance, the effective interest rate on that transaction is approximately 180% APR, nearly 3 times the item's retail cost for a washing machine. The people who use rent-to-own are primarily households earning under $40,000. The decision to use it is rational given their constraints. They cannot access credit. They cannot pay cash. The product is predatory by design, built on the margin created by that exact gap between need and access. This is not stupidity. This is what happens at the intersection of necessity and the absence of alternatives. Now, let's move from where you keep your money to where you sleep. The rent versus own math is in isolation one of the most important financial facts of the last century, and it is almost never presented with honest numbers. Marcus rents. He pays $1,200 a month over 30 years. the same period of a standard mortgage, he will spend $432,000. He will build zero equity. The money is gone. Every dollar of it spent, not stored. Daniel buys. Same $1,200 per month mortgage payment. Over 30 years, the loan is paid off. Depending on the market and the location, he has built somewhere between $200,000 and $400,000 in home equity, possibly more. The same $1,200 monthly payment produced an asset for Marcus. It produced a receipt. Now, renting is not inherently wrong. It is not automatically wasted money. There are real circumstances where renting is the right strategic choice, but the barrier to ownership is itself a structural cost. A down payment, a credit score minimum, documented income verification. Each of these is a gate, and the people least able to clear the gate pay the cost of being kept outside it for decades. And renters carry additional hidden costs that almost nobody adds up. Security deposits, 1 to 2 months rent, sitting with a landlord, earning zero interest for you. Renter's insurance, which is not equivalent to homeowner's insurance and does not protect the same assets. No mortgage interest tax deduction, which is effectively a government subsidy for homeowners. Funded by a tax code that offers renters nothing equivalent. And moving costs. Low-income renters move 2 to 3 times more often than homeowners, forced out by rent increases, lease non-renewals, building sales. Each move costs $1,500 to $5,000. Each move resets the deposit clock. Each move requires a new application, new fees, new credit checks. The annual renter penalty versus an equivalent homeowner, accounting for equity building, tax benefits, and move frequency, is estimated between $3,000 and $8,000 per year. And getting in requires capital that functions as a wall. Non-refundable application fees, $50 to $100 per application, no guarantee of approval. Apply to 5 apartments, spend $500, and receive nothing if rejected. And with a low credit score, multiple rejections are standard, which means multiple application fees, which means the cost of trying to find housing is itself a poverty premium. Last month's rent plus security deposit, often $3,000 to $5,000 required at signing before you have moved a single piece of furniture, before you have turned on a single light, just to hold a key. Let's move from where you live to what you eat. The USDA defines a food desert as a low-income area where a significant percentage of residents live more than 1 mile from a supermarket in urban areas or more than 10 miles in rural areas. 19 million Americans live in food deserts. This is not a fringe statistic. It is 19 million people navigating daily food decisions inside a geography that has already made those decisions harder. Price premium at convenience stores versus supermarkets, 10 to 40% more per item. Every item, every trip. Without a car in a food desert, and food deserts in carless households overlap heavily, add $5 to $15 in transit costs per grocery trip, bus fare time, carrying capacity. Every trip is more expensive in money and more expensive in effort. The annual food premium for a food desert resident, estimated $500 to $2,000 per year. Just for geography. Just for where they happen to live. And this is where the financial cost connects to the physical body. Cheap food is calorie-dense and This is not a moral judgment on what people choose to eat. It is an observation about what is available and affordable in food deserts. The long-term health consequences of a nutrient-poor diet, higher rates of chronic illness, higher medical costs, reduced cognitive performance and productivity, create a downstream financial drain that compounds over decades. The true cost of a $1 burger is not $1. It is $1 plus whatever portion of the long-term health and productivity costs that meal contributes to over 20 years. That number is not calculable precisely, but it is not zero. And then there is transportation itself. No car means paying more for nearly everything. Not just food. A rideshare to a medical appointment, $20 to $60 per trip versus $3 to $8 in a personal vehicle. A bus route that turns a 20-minute car commute into a 2-hour journey, which means 2 hours of lost income, 2 hours of lost time, 2 hours of compounding delay. The annual transportation penalty for carless households versus car-owning households. $2,000 to $5,000 more per year. And here is the irony. The system builds in a car costs money. A used, reliable car costs $5,000 to $10,000. Insurance, maintenance, gas, another $3,000 to $5,000 annually. But not having a car costs more than having one. The math runs both directions against you. And what about the cost of being sick without wealth? Your zip code determines your car insurance premium as much as your driving record. Same driver, same car, same clean record. Different neighborhood. Premium difference, $800 to $2,000 per year, based purely on where you park at night. Low-income zip codes generate higher claims statistically, so everyone in that zip code pays a higher premium, regardless of their individual record. And the response, predictably, is that low-income drivers drop to minimum coverage to reduce the monthly cost, which makes rational sense in the short term and creates catastrophic exposure in the event of an accident. One at-fault accident without adequate coverage is not just an inconvenience. It is a years-long financial crisis, a judgment, a wage, a complete reversal of whatever fragile financial progress had been made. Healthcare without insurance. Routine care becomes unaffordable. So people delay a doctor's visit that costs $150, cash pay gets postponed and postponed again until it becomes a condition that requires an emergency room visit. The math on healthcare delay is staggering. A $150 primary care visit, ignored, becomes a condition that requires a $15,000 emergency room treatment, not hypothetically, but routinely, for conditions that are both preventable and treatable at the primary care level. The cost multiplier on delayed care is not 2x or 5x, it is frequently 50x to 100x. Medical debt is the #1 cause of personal bankruptcy in the United States, and medical debt tanks credit scores, which triggers higher rates on every system they use as a credit score to set a price, which reduces the buffer, which increases the likelihood of the next financial emergency, which makes the next healthcare delay more likely. This is not a spiral in a metaphorical sense. It is a documented, measurable feedback loop. Dying poor is expensive too. The average fuel in the United States costs between $7,000 and $12,000 without life insurance. That cost falls on whoever is left, often a family already in financial stress, now absorbing a $10,000 shock at the worst possible moment. And the life insurance products most aggressively marketed to low-income households are often whole life or burial insurance policies. Products with high premiums relative to benefit, structured in ways that prioritize the insurer's return over the policyholder's actual coverage need. Term life insurance, which is almost universally the most cost-effective product for most people, is sold less aggressively to the market segment that could benefit from it most. Now, let's put all of this together into a single number. Let's be very clear about what we have documented. Banking fees and check cashing, $700 to $1,750 per year. Credit cost differential across loans, $1,000 to $3,000 per year. Rent versus ownership gap, accounting for equity and tax benefits, $3,000 to $8,000 per year. Food, desert, and transportation penalties, $2,500 to $7,000 per year. Insurance premium differential by zip code and credit, $800 to $2,000 per year. Healthcare avoidance and delayed care costs, $1,000 to $5,000 per year. Payday and predatory lending fees, $500 to $3,000 per year. Total annual poverty premium, $9,500 to $29,750 per year. Sit with that number for a moment, because it is not a theoretical figure. It is the sum of documented, measurable costs extracted from low-income households in the United States every single year. Not because they are spending irresponsibly, but because the system charges them more for existing inside it with low reserves. Marcus and Daniel, same gross income. At the end of the year, Marcus is paid somewhere between $9,500 and $29,750 more than Daniel for the same life, the same basic needs, the same human requirements. $1.5 million gone. Here is the lifetime math. A conservative $15,000 annual poverty premium 30 years. That is $450,000 in excess costs. Money that was extracted, not spent, not invested, not saved, just extracted by the price differential of being low income in America. And here is the opportunity cost that completes the picture. If that $15,000 per year had been invested at a 7% average annual return, the long-term historical average of a broad market index fund over 30 years, it would have compounded to approximately $1.5 million. $1.5 million. Not from recklessness. Not from failure. From a price differential that nobody explained. This is not a gap in effort. This is a gap in system access. And the generational math closes the loop completely. The parent who pays the poverty premium has less to pass on. Less for a down payment, less for the security deposit, less for the car that unlocks the job, less for the credit history that sets the starting APR. The poverty premium is not just extracted from one generation. It reduces the starting position of the next one. The system does not need to be malicious to be inherited. It just needs to be structural. So, what do you actually do about this? The escape is real. It is not easy. It is not fast. But it is sequenced and navigable. And the sequence matters more than the individual steps because trying to do everything at once is the fastest way to do nothing. Month 1 through month 3, banking first. Open a no-fee account. A credit union. If there is one in your area, look for community-chartered credit unions. Not the large national ones with fine print. Online banks, Chime and Ally both operate with no minimum balance requirements and no monthly fees. This one move eliminates check cashing fees, eliminates overdraft cascade risk, and creates the infrastructure for everything that follows. Direct deposit is the unlock key. The moment your paycheck goes directly into a no-fee account, the check cashing cost disappears permanently. And begin building an emergency fund immediately, even $25 per paycheck. The target for the first phase is $500. $500 eliminates the trigger condition for most payday loans. Not because it covers everything, because it covers the gap that sends people to a payday lender in the first place. Month 3 through month 6, credit building begins. The fastest legitimate paths, a secured credit card with a $200 deposit. Use it once a month for a small recurring expense. Pay it in full every month before the due date. Do not carry a balance. After 6 months of this pattern, you have a documented credit history. After 12 months, you may qualify for an upgrade to an unsecured card. Credit builder loans, available at many credit unions, work similarly. You make payments on a loan that is held in a savings account, released to you at the end of the term. The payment history is reported to all 3 credit bureaus. Becoming an authorized user on a family member or a close friend's account, provided they have good credit and low utilization, can add their history to your credit file. This is legitimate. It is legal. It works. The 3 fastest measurable moves to raise a credit score: 50 to 100 points. Lower your credit utilization below 30%, dispute any inaccurate negative items on your report using annualcreditreport.com, and add on-time payment history consistently. Free credit monitoring through your bank or through Credit Karma tracks the movement. Watch your utilization, watch your payment history. Those 2 factors drive the majority of your score. Month 6 through month 18. Eliminate predatory products one by one. The order matters. Start with the highest rate product. If you have a payday loan cycle, the credit union emergency loan or the credit card cash advance, Achi 25% APR, which is genuinely terrible, is still dramatically better than 391%. Replace the highest cost product first, then the next. This is not a dramatic reversal. It is a systematic replacement of high cost instruments with lower cost ones, executed one at a time. Month 18 through month 36. Conventional product qualification. With 6 to 80 months of credit history and an improved score, you'll begin qualifying for conventional financial products: a personal loan at a reasonable rate, a car loan that does not strip $9,000 in interest, a credit card with rewards rather than penalties. The price of your financial life drops category by category. Year 3 and beyond. Asset accumulation begins. Down payment assistance programs exist at the federal, state, and local level. Many offer grants, not loans, for first-time home buyers who meet income requirements. FHA loans allow a 3.5% down payment with a 580 credit score. How's hacking buying a duplex or a property with a rentable unit, living in one half, renting the other, can reduce or eliminate your effective housing costs while building equity. Rent reporting services now exist that reports your monthly rent payments to credit bureaus, converting the cost of renting into credit history. The core principle underneath all of it is this: every dollar saved from the poverty premium is a dollar that compounds, not one that disappears into fees. The enemy to compounding is not investment risk. It is extraction, and extraction is what the poverty premium does systematically, month after month, to the people least equipped to absorb it. Individual strategies matter. The steps in Part 8 are real, and they work. But I want to name something clearly before we close this video, because I think it is the responsibility of anyone who makes content about money to say it. The poverty premium is not fixed by personal finance alone. The structure that creates it requires structural responses. Interest rate caps on predatory lending exist in some states and not others, and the difference in outcomes is measurable. Banking desert legislation that incentivizes credit union access in underserved communities, credit scoring reform that accounts for rent payments, utility payments, and other documented financial responsibilities that do not currently appear in FICO calculations. These are policy levers. They are hell. They are slow, and individual action cannot wait for them. But the individual action and the systemic critique must coexist. Financial literacy content that only teaches behavior without naming the architecture is half a conversation. This video tried to be the whole one. Here is the truth. This entire video has been building toward. You were never bad with money. You were navigating a system designed to extract it, and doing so without a map, without the numbers, and without anyone willing to name what was happening clearly. The most expensive thing in the world is not a yacht. It is not a private jet. It is being broke. Because broke is a tax. And nobody gave you the tax code. Now, you have it. Share this video with someone who needs the math, not the judgment. Subscribe. Every week we cover the financial mechanics they do not teach in school. And tell me in the comments, which of these costs hit closest to home for you? I read every one.